Welcome to Market Monday from the investment team and the trust department at the First National Bank. We'll start today with a review of economic data points expected over the next couple of weeks, move into a review of the stock market, and then end with the interest rate markets. So while we have some data points coming, it's a less busy schedule than it's been recently. We do have a few important consequential data points coming, but the pace is slower than we're used to in terms of economic data releases. So starting it off, we have some information on the real estate market. We'll get information on the labor market, along with the leading economic indicators, which tend to forecast the direction of GDP growth as you know, out in the next periods forward. And what we're looking at here is they're expecting it to continue to slow. This number is expected to come in at 0.3% decline. And that's lower of a decline or less of a decline than the negative 0.5% it was in the last reading. So expectations are this indicator will show a continuing bias towards slowing economy, but with the brakes maybe being pumped a little less furiously. So as we move into later on at the end of the week, we'll get information on outlooks. Next week we've got manufacturing information, more real estate market information. We'll get consumer confidence, which is extremely important because this leads to consumer purchase behavior potentially. If the consumer is more confident, they're more likely to be buying, which means demand goes up, and it could potentially indicate a re-accelerating economy. And they're expecting it to show that. They're expecting this indicator, when I say they, the analyst community, expecting it to come in at 112 versus a prior reading of 108.7, showing an increasing consumer confidence and thereby implication, increasing propensity to spend. So we'll be watching that one pretty keenly. We'll be watching the Federal Open Market Committee's meeting minutes and reading that to see what were they discussing and concerned about at their latest meeting before they came out with their policy decision. We'll get GDP on the quarter-on-quarter basis, a revision, which is expected to be no revision. And we get the core PCE index, which is the Fed's preferred inflation gauge, and that's going to show by expectations 2.8% versus 2.7% in the last reading. In other words, market seems to be expecting that to tick up slightly on the year-over-year basis, but remain flat on the month-over-month basis. So, this 0.3, 0.3, 2.7, and 2.8, that might indicate it's only a seasonal effect, but we have to be extremely careful here because, inflation could reignite, particularly in light of the Fed's recent cuts, and we'll be discussing that here shortly. Rounding it out over the next 2-week period, on the 29th will be the Chicago PMI, which is Purchasing Managers Index, which is a sentiment indicator as well. What's going on in the markets? Well, a modest little pullback from all-time highs that, is it really a big deal in the grand scheme of things? Probably not. We still see uptrending behavior. We still see reasons for the equity market to be going up. So, it's unlikely to change. When you see a pattern like this, until we see a significant leveling off period, it's not likely to turn on a dime, although it could. And we seem to have gotten through the September-October period, which is normally the times when volatility is most likely in the year, without seeing that volatility too badly. So, it's not to say we're out of the woods. There's some significant things going on, particularly regarding the war in Europe, that could generate geopolitical market shocks. So we're paying attention to that. However, in all likelihood, we don't expect to see extreme volatility unless there is some exogenous event. Options market participants think the same thing. That's what this VIX index is, volatility index, trading at around 16.5 or indicating about 16.5. That is implying lower than normal volatility from the past recent period. Maybe perhaps the market breathing a sigh of relief after the election, not so much in the sense about which participant won or which party won, but more in the sense of there's not an uncertainty hanging over the market, which is what the market really doesn't like. Remember, we've discussed this before, that the political cycle, while it may impact markets to a degree due to regulations that come into it or out of favor, over the long term, it really is not a relevant factor as to what's happening with the market. In other words, we don't see evidence that politicians claims that they can, cause markets to do one thing or another are actually valid claims. We think that the market and the economy operate independently of the political cycle, on their own cycles. So moving into the Treasury curve, an interesting phenomenon is happening. the Federal Reserve is lowering interest rates in the overnight rate. Yet, we see longer-term rates rising, and in fact, an almost 10% rise in 7-year yields, a 9% rise in change, 9 3/8% change in 10-year yields, and a 7%-ish change in 20-year yields imply that market participants view the current environment as inflationary. They're looking at the longer-term bond yields in the government bond, the risk-free asset. The only pricing factor in there is inflation expectation. There isn't a default risk premium. So when these rates are rising over the longer term, that's when investors are saying, hey, look, if I'm going to loan money to the U.S. government, I better be able to at least recoup my inflation expectations and make a little bit of money for loaning that to the government. So this represents an increase in inflation expectations. And as we look at the corporate yield curve, that's done pretty much the same thing. Rates are up pretty substantially over the longer end of the curve over the past month, and we're getting back to really comfortable levels for longer-term investors, and that's what we want to see. And we also want to see this shape of a yield curve sloping up. That's very good. Now, the inversion has almost been worked out of the market in treasuries, and there's still a pretty significant inversion of the curve in corporates. However, that is likely to abate as well as we re-enter what appears to be a pretty healthy economy that's not going too slow and it's not going too fast in its growth. And with that, we will come out and say, yes, credit where credit's due. As of right now, it appears that the Fed has indeed engineered that soft landing where they've done a rate hiking cycle to its conclusion, changed policy, and gotten no recession out of that, just the right amount of slowdown in the economy to bring inflation under reasonably tolerable levels and not take the economy into recession. So are we concerned about this recent drop? Not yet, and we don't see reason to be concerned unless there is some sort of exogenous shock. But even if there is, remember that we're taking the outlook of a long-term investor. We have long-term plans, and periodic bouts of market volatility, regardless of the source, are baked into those plans. So if you have any questions about the way that the world is right now and how it might impact markets, or the economy and how that might impact markets, or just in general what's going on in the markets, feel free to call us. We love to talk about it. Hope you found the video useful. Thanks. Have a great day.